All right, what's going on, everybody? Today is going to be the first video for our 2025 lectures. We're going to jump in and we're going to get into the brass tacks of this, talking about the models I'm using, how I'm pretty much coming into each day, what I'm looking for, what I know ahead of time, what to expect, and how to look. We're going to kind of go over a lot of that today, but just understand this is the first video. There's going to be many of these. How this works is I basically use three. I don't want to call them zones, but we're going to call them prices. But just be aware there's more than one price to each level. I use these specific prices where I'm starting my trading at. Okay. So this means I'm looking to be a buyer here or a seller here because I view this as a fair value to either participant in the market. It's also a range where the biggest moves will come from. And that could also be a retracement on a previous move or, a continuation of the move. So it really just shows a lot of explosive movements that come off these levels. So I'm going to go over a few of the models I have, and I'm just going to say a couple of them, and I'm going to spend a video on each one, actually recording, uploading proof, but I'm just going to go through just so you guys could get an idea now of how in-depth this really went and is. So these are all just for first presentation. So I use first presentation, new day opening gap, and new week opening gap. Those levels will have the biggest price runs for the week. Okay. Being able to go on a 1 minute chart and study the low time frames around these prices and then the order flow from it and then incorporating time of day into it is lethal. That is where you should be looking to draw as a trader. That's time and price. That's specific prices at certain times being matched up, and it shows a nice reaction. So with having three of those prices or zones, whatever you like to call them, there's a lot of models that I could look at within each one. Okay. And this is just showing you how far this really goes. So for first presentation, it could be a first presentation run into minor buy side and sell side. Now, I don't want anyone to get tripped up and be like, oh, well, what does that mean? What buy side, sell side? It's very simple. 9:30 opens up. Boom. Here's the first swing high of 9:30. Here's the first swing low of 9:30. This is your first known point that the algorithm has to work with. So that being said, if we have a known point right there and we extend this price over, it'll feed back for it. And I always said the things to look for in a high or a low is things like this. When it spikes and pushes very fast all the way through. Like look at these 1 minute candles and then look at this one, right? When I see that stuff, I'm like, okay, I was on the right side here. These are the ones I want to study. Even this, it's heavy into sell side or buy side. That's what you want. That's a one-way movement, and then it just snaps, takes right off into buy or sell side. So I have minor buy side and sell side. So minor buy side, sell side is simply this first high, this first low. And it gets moved all throughout the day. So, and I have actually do have a presentation on this already. It's called initial range liquidity, but some of you guys thought it was only limited to doing it on the weekly. This is limited to sessions, daily, weekly, monthly, anywhere you want to get into depth. That's just the duration of time you actually have to watch it for. So these are our initial points. Notice how we made buy side, created sell side, and took a whole layer of sell side liquidity out. So it freed a lot of things up and then reversed. This is exactly what you look for. This is your classic Judah swing 9:30 opening price pattern. From there, you have first presentation, and I was a participant, and this was on Thursday. Right in here, we got our close up. It was wicking back. I was taking order flow. Stop loss sat right in the 6,083 and a half. That was our breakaway gap. And I claim that as a breakaway gap because we're inside first presentation. And I want to see it hold there. I understand it comes back down, but target was already hit. So I'm going to share something else about this up in here. But for this model, first presentation into minor buy side or sell side, was a go. This was a nice range. From there, this will always happen first when you're using first presentation. This one will always 110% happen first. It has to take these levels, it has to grow outside of itself before it'll run for previous days highs or lows or previous sessions highs or lows, whatever you're looking at in there. So this is one of the models. It's a quick little scalp that would range on a 15-second chart from here right up into 6,089. When you see 930 open up, you could have taken a short off of this once we close below it, but you run into we don't have an opposing end of the range created yet. So you're actually going to go make one. It's a little more unknown in my opinion, unless you have a clear gap. I mean, there's this over here, but I would even want one a little smaller than that, a little more precise, maybe just like one small one that was down in here. When you have something like that out to play, it makes it easier. But when you have, a whole range and you see some heaviness, it's kind of hard to tell where it's going to actually turn around, in my opinion. But that's why we use things like first presentation to guide entry because it doesn't matter what it wants to do down here, how long it wants to do it for. You know it's going to get a price from here into buy side. So that is just one of them. I then have first presentation into London higher low. That would be ranked at number 2 because this would most likely be what will happen next. There's one other one, and we're just going to touch lightly on it. I'm going to combine that with a minor buy side and sell side lesson, but it's just called open inefficiency. So in other words, it would have been like this, which is what I was just saying. If you had a gap, you could take it from that into any open inefficiency you have from the morning. So now it's from 7 a.m. forward. Is there any open inefficiencies? So down here it balanced itself up, just chop back and forth. This was before 7, so ignore it. So it pretty much bounces off. It's just this. And that's exactly what we do. We laid a body over it. So you could have someone who likes just this model is building you're pretty much working within the manipulation point of it, but that's completely okay. Um you're building short entries in here to take them into sell side, and then like I said, if this was a smaller gap, it could have been an easier target, but you give and you take sometimes. So from there I have London high or low. Okay. So I'm going to just run over these and explain how they'll look like. I will also just, as I'm speaking, be sliding back to see if I could see any of these off, the top of my hand just quickly. We're going to go into NQ because that's where a lot of my studies and focus will be. I just want to show you the trade I actually took this past week. And I know that NQ kind of had some sloppier gaps going into the end of the week, but we take it from first presentation into London high or low. Okay. So that is obviously going to be a run where you have an obvious 2 to 5 a.m., but more specifically like 2 to 3:30, a little tighter of a range. You have an obvious buy side or sell side pool just sitting out in the middle of nowhere. It didn't run any highs. It was just, created off a retracement from the previous day's range, something along those sorts. And you see price just stalling there, and then we create a first presentation, so an opposing first run, and then you see it take off. So I'm just getting into this in here. So I do not believe there was any setup in there. Um, but it could look something along the lines of this because, like I said, I'm going to have a video that'll show you everything in each model to a T. How often? Because I'll show you how I note keep too. But I do have all files on each one of these cases and how it runs there. And you'll see each one might only happen 1 or 2 days a week, but it's where you're approaching, right? I'm not gonna take first presentation into new week opening gap when, I have an open inefficiency above us, something like that, right? In the new week opening gaps below us, and we're only on Tuesday. you have to pick and choose. Day of the week is specific. So when I'm labeling these, I'm labeling this as, this would be Thursday. Um, Thursday, 2/13/25, and this would just go under, say, first presentation to London, high or low. So let's say, so I mean, there was a London high or low. It's just the thing that isn't easy to work with is it already ran it before it came back. So for this example, I'm just going to throw price up there, and we're going to say that this was our London high or low. Price worked down. It created London high. It worked down. Maybe it took out some sell side coming into the morning or 8:30, dropped into the previous day's low, something like that. And now it's turning around. Okay, so you could kind of tell already. I just gave you a nice little hint in there. The days you're going to see this is when you have 8 to 8:30 um create an opposing end of the daily range. So 8:30 news, something it would look on a day like this. This is why I'm picking it. 8:30 has a current higher low, but what you're mainly looking for here is first presentation to the sitting London higher low. So it runs up. You could have wanted to use it in here. Okay. My rule of thumb is allow it to close on the outside or directly drop into 50% and then show a wick. If it does that, you could also take entries off the high and then that top quadrant. You have to see how the candle closes. Okay. If it does, if it's something like this where it wicks at one time and leaves, you're not going to get a part of that. But if it's in here now, it's wicking off the high and stuff again, you could be taking entries in there. If you did that in here, it blew right through it. You have to wait. It closes here. Look at that entry right in there. Boom. Take it up now to the high. When it's above this high, your stop loss is at break even. You're studying a one-way run. Okay. So it comes back down, would have stopped you out. You could still be looking for longs up in here. I have a two loss limit on each of these levels, which means I could take two losses and then it'll be it'll be over with. It's done. Uh, I won't look anymore. And the times you win, it'll greatly exceed those losses. But pretty much, let's say you took this entry right here, stop loss was sitting right in there. You took it up into the high. I took this exact trade, and I have pictures of it inside the Telegram. You guys could go look. It ended up coming back down. This one had stopped me out. This movement right here, right below this candle, had stopped me out. But I was able to clean one up above the high. So if I'm dropping two lots right here, or two contracts, I'm taking one off here and I'm holding one for the London higher low. It ends up coming back down, and this is what you want to study. The one-way fluid motion. It's okay if you take this and you miss it, get stopped out. If you want to re-enter and risk any profit you made, be my guest. If I made, 800 to 1,000 bucks, I'd probably just call my day, and still study this run, but that's all it takes for me. And you're looking at the order flow that falls between these levels at all times. So ideally, if you could get entries down into these levels and have something to anchor on. So let's say you just entered off of the order block, or that's what you saw. So you enter off the high here, stop loss sat here initially. That's completely permissible. And then you choke it up as it's moving away because you're expecting it to do just this, a one-way price movement. And this would hit London higher low. And I am very well aware that is not the London higher low. But like I said, for this example, we're just going to say it was. And when I go through and actually do the singular video on it, I will obviously have examples up the days it mostly occurs on. Because like I said, this is all day of the week specifics. So what I would do to that, I'll just throw a line back. I would say I would download this image. So I would take a screenshot of this. I would download it and I would label it like this. This would be Thursday, 2/13/25. And I would say first presentation into London High. And this has its own folder. Okay. And that's how it would be labeled. And I'm studying this run right there because those runs repeat all the time and they're one-way price movements. So if you know a one-way price movement will come, all you then have to do is go in here, learn how to read a 15-second chart, and now look. And the way I teach is I teach you guys should be able to trust a down close candle to support higher prices. Okay. So as you're closing, so where's your first down close candle? Boom. Did we close above it? No. Did we close above this? No. Did we close above this one? Well, that's the last one we have. And yes, we did right here. So you're trusting this. Price should not drop below this. From there, you get new down close candles. Did we trade above them? Yes. Where? Not right here. It has to trade above it. Right in here. Right in here. From this point, did it come back down and hit this level? Yes. Boom. If you want to call this your down close candle because you got a new one and then close above that, go ahead. I like this because of the body size. Bigger body than that. New down close candle. Did we close above it? No. New down close candle. Did we close above it? Yes. Where? Right here. Did it act as a support to higher prices? Yes, it did. We move up. New down close candles. Fair value gap. Order flow. So anything in here could be entries. If you miss the entry or you like to just scalp. Some people might just want to scalp. And then for those that do, I have something that I use called timed arrays. And it's basically the time these candles format on a lower time frame, like the 15-second, it has to be a specific time in there. It's a little too complicated to teach all in one sitting, but it would be since this is 10:16 and this is 10:16 and 30 seconds into it, it's good to go higher, right? So I'm basically looking at certain minutes every hour. So it would be like ones, twos, six, seven, eights, 13, 14s, uh, 21, 22, 26, 27, 28, 31, 32, 33, 34. Like all those minutes, it could print some type of array. And then I'm in the 15-second, and then it shouldn't hit it right on the next candle. It should be the candle after that. So that's how I'm using this stuff, and it should look like nice order flow in here. Okay. So it's like as long as it hits into this candle, since this was once I said 13. So there you go. So now we're in 1013. It created a fair value gap, and then it has to go after this would be 1430. Boom. Touches it, and it's gone. So it could get even more time than that. And like I said, that'll be for a later lesson. But order flow is taken straight up to it. And like I said, I'm well aware that's not London's higher low, but that's how exactly it'll look. These are the runs you're studying off of this. So the next one that brings us to is previous day higher low. The previous day higher low is one of my favorite. It offers, in my opinion, the biggest movements. And on top of that, uh, it'll offer usually some 5 minute, some 1 minute order flow, but it's very explosive. So it tends to be like one of the more explosive runs for the week. And it's actually one of the harder ones to trade, but it now became easier just because it's a little more day specific. Okay. Um, I'm going to look just very briefly and see if I could find one that I like. Okay. So here, since I'm seeing this now, and this day we're gonna see already is gonna be horrible. And I know that that sounds like an excuse and stuff. That's okay, but I'm giving you a heads up. It's gonna be horrible. It's a seek and destroy day. It's on a Friday. Um, it that looks like seek and destroy to me, but I'm still gonna show you what this is. So this is our London session high because this is the one we just did. So notice how it's a clear high. We drop down. I told you guys eight between pretty much your morning session, and usually it's 8:30. You want to see punching a low. and then price starts pushing higher. 9:30 will just be like rocket fuel and keep us pushing higher. Now, this is completely unorganized. And this would be your day where if you were studying this, you would have taken a long here. You would have gotten profit. Don't get it wrong at all or twisted. If I'm 20 handles in profit and my entry is inside of this, it's going stop loss to break even. Like I said, you're studying a one-way run. Does that one-way run right here or right here have any of this into it? No, it doesn't. So that just it's showing you it's not ready. So if you're getting an entry here and it's leaving, throw your stop loss to break even because at times you're studying it. It should also just be one way. Don't do it the very next candle, let it close away and start creating a down. I would say once you have a down close candle and price closes above it, I would feel okay to do that. But look at the motions there. Boom, boom. Very nice one-way movement. So let's say you got in here. You rode this 20 handles, stop loss break even. Boom, this one stopped you out. It took off without you. You're not re-entering up in here because you got missed. Your first thing to do is you want to enter down in here. If you miss that, sure, you can enter the order flow. If you want to enter there and you take a loss, so be it. I probably wouldn't do that directly ahead of 10 a.m. You have to look at timing. So like it's 9:59 right here. You're getting so like you want to enter at 9:58 when it's that close and 10 a.m. is about to come out. In my opinion, it's like 10 a.m. is likely to nudge into that and then explode. But I'm not saying I knew that it would do that. I'm saying that's what I would just expect out from trading and seeing things over time. Price has a nice movement higher, off 50%. That's a nice study right in there. It got very close, but it didn't quite make it. And like I said, you would be slamming your stop loss. So you would have gotten stop down profit. So down close candle traded above it. Did price overtake that candle? No. New down close candle. Do we close above it? Yes. In here, did price overtake it? No. New down close candle. Did price overtake it? Or did it trade above it? Yes. Did it overtake it? No. So you would have gotten stop back out right about here. So regardless, you still could have gotten a nice 25 handle run. Now, for me, 25 handles with one contract is roughly $500. Now, if you had 4 or 5 contracts, you're up a couple $1,000s right there. You're trading above highs. You could have taken a partial off. So this is, back to our what I was saying. So in here, you have a run from the high into that initial range. You have London high sitting right above it. So this is one of those ones where you could have taken it, taken a partial, maybe got stopped out, whatever, taking a new partial when it trades back above this high, you're now taking out the new high of the day. Look at what's happening after it. It wants to run down for some version of sell side after it's punching out the new high of the day. Times where it's very bullish, it'll just run, and that's fine, but that doesn't happen every single day. So this is a true London session one. Now, like I said, I visually do not love this just because of how many times went back and forth and came back to it and touched it, and I'm not I don't love this setup, but it's still, you would want to study 15-second order flow, where the entries could have been, where the stop loss could have been moved to, all the way up, because that is how you find great tight entries, low, small stop losses, and you're in and out in a few minutes. So you also have new day opening gap, new week opening gap for the first presentation. So what is that? I have a nice little indicator to help us out there. That would be I want to find a nice example for you. It might look hectic, but we'll sort through it. Okay, so here we have the other example. So I'm going to limit these. And like I said, all you have to do, I know this is a lot, but all you have to do is actually just watch one of them. We're watching this one right here. And this is very small. I'm well aware of that. Oh, and this was the day it didn't touch down into it. But this is going to be a similar study. So you have, and this is going to be what the day looks like most of the time. You have a very consolidated opening. You have 8:30, something like CPI, FOMC, NFP. It's a very quick one-way price movement. Stalls, whatever. 9:30 now opens up. First presentation, and you're trading it back to new day opening gap, which is sitting below that high created. So the goal is always to trade back above that starting point for the news. If you have new day opening gap in front of that, trade it to new day opening gap. Although it ran higher, there's a look at what happens. It's a pretty it's fairly quickly of some swift runs. Nice one deep retracement to each leg, but for the most part, they're pretty clean price runs. Once it hits it, look what happens. Slows down. Look at how you spend, and I'm well aware it didn't hit into it, but 933, it hits it by 12. So, figure, what is that? 2.5 hours. And then from there, here's 12. It took until almost 5 to hit it. So there's a big that like that's why it's you have to expect it to change its character once it arrives at one of these levels. It's going to change, what its motive is for the moment. Um, when ICT says it's like it's picking up information, imagine it like that. It's saying, oh yeah, distribute higher off of this level, distribute lower off of this level. Once you get to the next one, consolidate and pick up more orders, or hit into it, retrace back on the next, and then come back and consolidate. There's all these different little nodes that can happen off of this. And surely, new week opening gap is the same thing. This is going to show us a run from first presentation to new week opening gap. Now, this is going to be a little different. There's a couple ways you could use it. You could use it if it's in it, creates it at one of the levels like this, and it's pushing out of it. But if you're using it as a target, okay, I'm going to find an example. I think this week doesn't have an example because that one day dropped all the way down into new week opening gap. So it will not show us anything. And those ones are very large. So there's some big new week opening gaps. But this is also how I'm back testing as well, things I'm doing. But aside from that, um, I'm able to come in here and when I'm logging this information and I'm taking the data down, I'm seeing what days is this likely occurring on. Um, what are the circumstances that's going on before it? And you're building a narrative. So when I'm coming into this and I want to find a good example, I just don't even know where the new week opening gap is. As far as it. Let's just go back. Okay, let's see. And when they're so large, you could use it as a target, but it's a little bit tougher. So here's an example. You have buy side at 8:30. Price ran it at 9:30. First presentation. Could use it as an inversion. And it's a drop down and hits it right down here at 2:30. I know it's long, but it hits new week opening gap. Like I said, it's just that's just so big. It's better when it's smaller. And ideally, I know this looks hectic right now, but I could kind of navigate my way through it because I'm just following actual price where things are opening. Um, yeah, because that one's inside of it. So, and here we go back to the beginning. So it's gonna look something like this. Okay. Let's say this is new week opening gap. Okay. You have Monday, it opens up, or Sunday it opens up, whatever. Say this is the closing point. This is the opening point. Price trades down, whatever. It's doing its thing, whatever the hell it wants to do. Okay. From here, it now this is all Monday, right? So Monday it's doing its thing. It's going all over the place, creating its ranges, its initial ranges. So now here's Tuesday's buy side and sell side. Tuesday, boom, trades higher. Okay. Consolidates whatever. Wednesday now takes out Tuesday. Hops over it. 9:30 first presentation is in a spot like this. Now you have day of the week specific. You are taking this setup when you have a higher low of the week in place, and now you're going to go rush down towards the opposing end of the range. So when you're using first presentation to new week opening gap, you essentially are going to take out the low of the week or at least minimum get to that new week opening gap. This is the environment you're trading. It's more of 1 to 2 opportunities a week. And then the other thing too is, if this is, say this was Tuesday's first presentation fair value gap, you could use this. And then, if this was Monday's, it was maybe hectic one, you could use it like this. But you're looking to take it from, you know, Wednesday now into first presentation and study a run down into first uh new week opening gap. And then like I said, you could hold to see if it wants to trade into 21,519 because that is an entry that would be in the category of a weekly swing. So these are all geared and set up to allow for all types of traders now, if you were able to understand that. So just using first presentation as an entry or a starting point, if you will, you're able to say, okay, do I want to trade it just to the minor buy side or sell side and scalp it? Do I want to trade it into London higher low and take a little bit more of a scalping slash day trade? Do I want to trade to previous day's higher low for a day trade? Open inefficiency falls in the same category as minor buy side, sell side. Do you want to trade it into previous day's higher low? Or do you want to hold it now and trade into new day opening gap, new week opening gap? New week opening gap might be a few days, but these are all things I'm monitoring and I'm noting. I'm going to take off a couple of these, but this is going to just be our intro. And like I said, this is so we're going to look like this. Ready? I'm going to add a couple more of those on there. We're going to look like this. Okay. From here, how do we write this? Okay. So this is everything that would fall under first presentation. From there, we have one for new day opening gap. Now this is only taking entries off new day opening gap. Only taking entries off new week opening gap. So there's all these categories where you could be targeting. So it's first presentation to minor buy side, first presentation to open inefficiency, first presentation to London higher low, first presentation to previous day's higher low, first presentation to new day opening gap, first presentation new week opening gap. You have to see what's on the menu, and you guys will see I'm doing this each week. That's why I'm saying some weeks it's like, okay, look at this level. Some week it's look at this gap. Some weeks it's or days it's look at, London higher low, look at new week opening gap, new day opening gap. And I'm throwing these targets out there, but you have to see what's on the menu, what's open. And if nothing looks that open, or you're out there, it's a Monday, you're just taking out minor buy side and sell side levels and you're scalping it. I'm going to share with you guys because this was going to be the intro just for first presentation. So I'm going to share with you guys how we are going to do new day opening gap and new week opening gap in other later lectures. But I hope you guys got a nice little introduction and a basis to how we're going to do this. Now, from here on out, this is going to be one of the longer videos, but the next one will be just a focus on runs into minor buy side and sell side liquidity. From there, it'll go to open it. I'll do minor buy side and open inefficiencies together just because they're both scalping targets. From there, we'll graduate into London higher low, previous day's higher low, new day opening gap, new week opening gap. I'll show you guys how I log. I'll show you guys a little bit of my logs that I have and how they work. And then I will show you guys just the order flow. And I'll show you guys how to document this, how to keep a record of it, and start pretty much building your own model. And you'll see I'm doing this stuff week in, week out, and there's no questioning as to if I'm nervous to get in, if I'm not. You guys can clearly see, this was Thursdays. Look at the reactions we had in there. And I'm sure a couple of you guys even saw it. I had taken, you know, us long, write it down in here, into buy side. And I wanted to get that run all the way up in there, but I was trailing my stop and it did stop me out right here. And I just didn't get it. And since it was a Thursday, I was like, I'm fine with passing on it for the rest of the week. And, it offered such a nice price movement. And then even later in the day. So here's another thing now. First presentation, it goes even deeper. And I'll share a little bit as we go, but there's using first presentation now in the PM session, using previous day's first presentation in the London session. There's all these different models, and it's just taking it from that level to this one because it's where it's predominantly um, most likely to go to. So that being said, guys, I hope you guys learned something. I know this one was a little lengthy. They will not all be like this from now on. Each individual one specific will be roughly, I would say, it's under a half an hour. So shooting for like a 20-minute video, I think that's a fair meeting ground. Have examples, like I said, showcase some of the documents I already have, and then from there we'll dive right into it. So I hope you guys learned something. If you guys have any questions, feel free to go over to the X account or on Telegram and shoot me a message.